All right, guys, welcome back to another episode. I'm your host, Cobra Trading. I know that I haven't done a video in quite some time. I was working on another project. I've now withdrawn from that so that I can go ahead and focus on creating content for you guys. So with that said, I want to go and explain the fundamental differences between trading stocks, trading Forex, and trading digital assets. They're very different. We're going to go ahead and explore the fundamental differences between those, and then we're going to go ahead and take a look at some charts and compare what the three look like on the charts when you're using the same old indicators that everybody has heard of. For instance, the RSI, MACD, moving average crossovers, and stuff like that. So without further ado, let's go ahead and get into it. All right, welcome back. So the main fundamental difference that I want to point out is one that should be super obvious to anybody that has any trading experience whatsoever, and it's liquidity. You've got your Forex, which is in the trillions, tens of trillions every single day, to your stocks, which is in the hundreds of billions or tens of billions every day, and then to your digital assets, which is definitely last and on the lower end of the liquidity scale. These numbers obviously are not exact, but that's basically the order in which they go. Forex definitely has the highest. That's the first reason. That leads me to the second one, which is when you have something that's higher in liquidity, the spreads are a lot less, so they're easier and faster to trade. So obviously they also go in the same order. So you've got your Forex, and then you've got your stocks, ETFs, mutual funds, bonds, and things like that. Commodities too, and then your Bitcoin on the lower end of the spectrum. But besides that, there really isn't very much of a large difference besides the fact that Forex versus like stocks and Bitcoin, there's no the rules of supply and demand don't really apply to Forex, right? Because you've got your world governments, we've all got paper money and coin money, and the governments can just print more money, and there's no end to the supply. There's a lot more that goes into it fundamentally than there is in terms of supply and demand. So when I trade Forex, for example, I don't trade off of any of the fundamentals. I literally just trade off of what the chart tells me. I'm a technical trader. That's how I've always been. I do my fundamental analysis when I'm investing in something. For instance, a new stock or a company that went public, or if I'm looking at investing or laddering another buy into palladium or copper or silver or whatever, that's when I'll go ahead and do my fundamental research. Or if I'm investing into a new altcoin or a new shit coin that I want to hold on for a while, if it's going to make me some money, that's when I do my fundamental analysis. But when it comes to Forex and stuff like that, and the big tech stocks, your Apple and your Netflix and Amazon and Google, Microsoft, IBM, all those, I don't really do any research on those. It is what it is. Sure, the news does affect it somewhat, but I mean, the liquidity is so high. Market sentiment is pretty much what you're seeing on the chart. So I don't really do that. That's just my own personal preference. I know I'm going to piss off a lot of people by saying this. All you hardcore fundamental traders out there, I know that you do your thing. You dig through news all day. I personally don't have the time for that. So if you do, kudos for you. Keep it up. I'm sure that it helps you with your trades. I just ignore all of it. With that said, let's go ahead and we'll take a look at the charts here, and I'll go ahead and start explaining why some of these indicators, you're going to see very large differences on how these indicators work, and I'm going to use the same ones across different charts and go ahead and just kind of explain how that works. And hopefully this will give you some insight into maybe if your trading plan or your strategy that you had up to now, maybe it wasn't going as well for you. Maybe you were only maybe it was like a 50-50 or like a 55 or 60-40 ratio or something, and you can't really figure out what's going on. 90% of the time, new traders that I talk to, this is what they're doing wrong. They're trying to invest in multiple things at the same time and start off with a diversified portfolio. That's a good thing to do. if you have the money to do it. I wouldn't suggest doing that if you're starting with less than $5,000 or $10,000. If you're starting with $1,000 or $2,000, you just simply don't have enough money to diversify it into that many things. If you're starting with $1,000, that's a good place to start off with, like maybe digital assets or Forex or something like that. Forex is always traded on leverage, so you can make more money with less. However, that also brings in more risk because you can lose a lot more money as well. So you have to really be careful and know what you're doing. I don't want to get too far ahead of myself, so I'll go ahead and we'll flip over to the charts real quick and I'll go ahead and explain some more for you. All right, so here we are taking a look at some of these charts, right? And first I wanted to show you guys two things that are more similar than Forex. Now, even though an index like the S&P 500 and Bitcoin are very, very different in terms of how much volume they have, they're equally as volatile. And I wanted to address this first because I know that I was going to get a whole bunch of trolls like, oh, how are you going to say that the stock market, like an index, isn't as volatile, blah blah blah, like a keyboard warrior trolling me about this. So I want to address this first. Yes, these two are more similar than take an index and Forex, or Forex and Bitcoin, or whatever. And the reason why is because this is an index. It's not one commodity or security. It's literally tracking all of them. And this is a brand new chart. I just started a new chart layout. This is the S&P over here. This is Bitcoin, as you can tell up here. Just keep that in mind. S&P on the left, Bitcoin on the right. Let's go ahead and bring up the MACD indicator. I know that I mentioned that before. And here's what I want to address, right? So in general, the MACD indicator is complete fucking garbage. It does work a little better on higher time frames, but in terms of low liquidity or low volume securities like Bitcoin, I'm about to show you why it's even less accurate on things like that. Like if you're using this for like altcoins or something, it's terrible, especially on 1 hour and below time frames. If you're using this, sometimes it's even still bad on a 4 hour. So, okay, so check this out. Back in, early last year or whatever, this is the S&P 500. I literally just went to a random spot on the chart. Shit, I'll go to even more of a random spot on the chart. All right, let's go back here. Okay, so let's say, you're trading along, there was just this big downtrend. You notice that the MACD crossed the 0 line, and you started getting a negative histogram, and then bam, wowzer, you got a MACD cross. It looks like it was confirmed on this candle close. You never want to enter a trade on a candle open, by the way. I mean, that's like trading basics 101. Never enter on a candle close. So you would have entered here on confirmation that the MACD had crossed over, right? I'll zoom in closer so that you can see that. Here's where it crossed. On this candle close, that would have been a confirmed cross. Now, that still would have been a little riskier for me. The histogram only just turned green. This could have easily reversed and continued the downtrend because this didn't really have a trend. It was stupid magnet. This really didn't have a trend. It was literally just going sideways here. Like, this was trash. Not something I would have traded until I would have seen something like this on this candle close. Like this, knowing that even though it was a red candle, yeah, sure. First of all, it's better to enter on a red candle. Second, the MACD was growing further apart on this close. Now, even though the volume was decreasing, the MACD was coming up. So a little divergence there. And sure enough, the market, started going up further. We got positive on the histogram, positive, positive, positive. Here you probably would have ended up getting stopped out, right? I mean, the MACD isn't super reactive like that. It's a highly lagging indicator, so it's not good for these short swings. And this isn't even really a short swing. This would have been for me on this. If I entered here, would have been 1, 2, 3, 4, 5, 6, 7, 8, 9 or 10 days. But I mean, you still would have gotten stopped out. I mean, this definitely would have hit my stop loss for an index. On index, I tend to set stop losses pretty tight, normally 1.5% on index options and futures trades, because they do swing a lot. Now, this entry would have been really good for this little swing right here. If you were monitoring it and you got out, you said, oh, look, it's hitting this resistance level right here. Let me get out. it would have been a good trade. If you have common sense, you would have seen the histogram, you know, turn over here. The latest you probably would have gotten out was here. And, you know, even though it's not a fantastic trade, you would have made some good profit. Any gains are good gains, right? So over here, conversely, on Bitcoin now, you see the MACD over here. Let me zoom in a little further. I'm actually going to get rid of the volume indicator over here for 1 second. What the hell? Oh, my dumbass. Here we go. Okay. So no trade zone, no trade zone, no trade zone, no trade zone, barely any movement, and the price is decreasing. This would have been a risky area, even if you were shorting on a high time frame. Even this would have been risky. I would not have played this. This would have been a nice play, but, well, Bitcoin has a lot lower volume. So guess what? You had confirmation after this already happened. You had no confirmation here of this happening. You still had a green histogram. So you wouldn't have caught this initial move down, which was basically this whole thing. And then when you did get across, you would have entered here on this candle close and then stopped out on this next candle. So that's the first example. MACD sucks. Second, I'm not really going to be hating on the indicators this time. That's going to be for another video. But anyway, you would have missed that entire move. Why? Well, because there's less volume. Volume affects these indicators, right? Okay, how much volume is in Bitcoin or the index or whatever, that affects how these indicators are working. So here you had a confirmed cross on this move. Good. You would have entered on this candle close. So you would have gotten in about here, stopped out immediately before, and you would have gotten stopped out before this huge move happened. Sucks. Why? Well, because even on a daily chart, which, by the way, MACDs and RSIs, those are meant for higher time frames. That's why I laugh when people are using these on lower time frames, like the hour chart and, you know, like the 15-minute chart and stuff, and they're using the MACD. The MACD lags so much. It doesn't matter what time frame you're using it on. The lower time frames are even worse than using it on a daily chart. But in lower liquidity markets like this, it's really, really terrible. Okay, so let's look at something even lower in liquidity, right? Let's look at let's go to my altcoin list. Let's add I just started my altcoin list on this account. Let's go to XRP just for shits and giggles. XRP on Binance, right? Okay, this is, why did it like dump me in the middle of the chart? Whatever. Let's go way back here. Scroll. Cool. Random example. So I'm not cherry picking, right? Dead volume, nothing. Well, let's make this full screen. Yeah, even on the daily chart. Ranging. Finally, you had a confirmed cross here. The initial move from this bottom already happened. Notice you were not in on this move at all. You weren't. Look at this MACD histogram, right? You hadn't even crossed the zero line to come back up into positive territory. This is still on a day chart. So you would have missed this candle. You would have missed this candle. You would have gotten in on this candle close and come up here. It would have gone sideways. You probably would have exited somewhere on this sideways movement. And then if you didn't, you would have ended up getting stopped out at break even here, or just about break even. Very little profit. This move you wouldn't have caught. Well, you might have. You would have caught it maybe about here on this candle close and gotten up here. Here's another example. You weren't going to get in at this bottom either, right? Here's the bottom. You didn't get your confirmed turnover on the MACD. You never open a trade on the first green histogram. That's a really dumb idea. Why? Because look at this situation over here. This happens and this and this. It happens all the time in crypto. You get these little blips of histograms. So like, oh, look, the downtrend's over. Boop. If you would have entered here, you would have gotten screwed. And then you would have had this, and then you would have gotten really screwed. If you would have just held through this, you would have gotten wrecked on this move. Anyway, that's basically, and even XRP is still pretty high liquidity. Let's go to like something that doesn't have very high liquidity. Let's look at what's a low liquid, low volume coin. Let's do Wabi. Wabi's pretty low. Okay. Oh my god, this is absolute terrible trash. Perfect example of why the MACD indicator is just shit. How the hell are you going to get a signal from this? This is like the most recent, well, it's not the most recent price action. This is the most recent price action, even all through here. How are you going to get on such a low volume coin using an indicator like this? How are you getting a signal from this? Like, what, are you just going to are you going to do one of these? I mean, still, look at this. What's this? What the hell is this? What is this? Like, you can't even get a decent signal from this. And this is a perfect example of how low liquid coins. Now, this isn't to say that this coin's not going up and down. I mean, look at this. I don't know if this is manipulation or what, but you know, this is a good example. This is what a low liquid coin looks like. Look at this chart, and now let's go ahead and do one of these numbers. Come over here, and now let's load a Forex chart. Let's load the Euro USD, right? Super high liquidity. Now, are there big swings in this? Yes, absolutely. But like I mentioned before, Forex is not reliant on supply and demand. This is basically off of, you know, news and stuff like that. You know, maybe if you're, you know, like a pattern trader or whatever, maybe you saw a pattern here. You know, something like this. You saw a pattern. Oh, look, it's going to break out. Oh, yay. Well, you would have actually gotten in this trade because this MACD is going to be way more accurate on a high liquidity. Let's click auto on a high liquidity thing. So boom, right as soon as this candle closed on the break of this little, you know, pattern here, you would have gotten in. You wouldn't have gotten stopped out here, even though it retested the top of this, and you would have been on your merry way. Notice when we had this little blip here, it's not like this, where you get this little blip on the indicator. See what I'm talking about here? It stays red. It stays below the zero line. This stayed below the zero line too, but it had enough force and it has such low liquidity that it actually changed the histogram color. That will not happen on a Forex. That will not happen on an index. That will not happen on high liquidity things when you're trading stocks and stuff like that. Let's compare this now. Let's go over here. We'll change this and let's go to let's look at oil, right? Oil, super highly traded, right? Let's go back in the chart, go to a random spot, boom. Okay, let's look here. MACD turned over here, got rejected on a little pump up here. Looks like bearish divergence. MACD coming down. Price going up. This would have been a notification here when this didn't cross for more bullish momentum. This would have been a huge sell signal right here on this rejection. You probably would have gotten in on this candle, and well, that really, you wouldn't have gotten stopped. Well, yeah, you may have. Well, let's zoom in here. If you got in on this candle close, no, it would have been this candle close. No, it would have been this one. This candle close, you would have almost, if your stop loss was up here at this support level, you wouldn't have gotten stopped out. But if you had a pretty tight stop loss, you probably would have gotten stopped out of this. Anyway, you can notice though that as this is going, look at these ups and downs in this. Look at these ups and downs. Now look at this. The histogram never changed over to green. It never came back above, the histogram never came back above the zero line until here, where it had a massive trend change. This would have been your confirmation on the second histogram, and you would have gotten stopped out. That's just an example of why this indicator is trash. But my point that I'm trying to prove is that on high liquid assets, you don't see the histogram do super small, like, you know, little pops and ebbs and sways and stuff. You know, for the most part, you see it stay above or below, you know, for an extended amount of time. Now, keep in mind, this is the day chart. If you come down to a 15-minute chart on this, it's going to look terrible. You know, like, this is trash, and it's just not an accurate indicator in general, but I'll go into more detail on that on a later video. Anyway, that is pretty much all I have for the charts. I compared Forex to a commodity. I compared Forex to crypto. I compared crypto to an index and gave you multiple examples on each one of these on completely random charts. And I hope that that was helpful. And I'm going to, like I said, I'll get into more indicators and a strategy that I use later on. All right, everybody, that pretty much sums up today's video. So make sure that you hit the like and subscribe button, and make sure that you ding the bell for notifications. I'm going to be coming out with more videos like this more often, and all of the information that you need about this video and for others is down in the description below, along with my Twitter handle and the Discord channel that I am most active in, that you guys can get a hold of me on a regular basis. If you have questions about the video, or you have a request for a video that you would like to see me make, let me know down in the comments below. And until next time, happy trading.